If your fixed mortgage is up for renewal in the next 1 to 3 years, you could be sitting on a $9,000 mistake or a $9,000 saving and not know it yet. I'll show you exactly which one applies to your situation. The decision comes down to one comparison: the cost of breaking now, your penalty plus the interest on a new rate, versus the cost of waiting until your renewal date, where lenders generally waive penalties. According to the Financial Consumer Agency of Canada, most fixed mortgages charge the higher of 3 months interest or an interest rate differential, and that IRD is where the big numbers hide. Let's meet 3 homeowners and run the numbers. Sarah has a $400,000 mortgage at 2.49% fixed with 2 years remaining, and she's tempted to break and lock a new 5-year rate today. Because current 2-year rates sit around 4.80 to 5.0% per Bank of Canada 2025 data, her contract rate is far below market. That gap is exactly what drives the IRD penalty. Sarah's payout quote shows a prepayment penalty of $12,400, driven by IRD because rates rose so far above her 2.49% contract rate. That's nearly 5 times the roughly $2,500 3 months interest figure. Modeling shows she'd need renewal rates to jump above 6.50% before breaking early clearly wins. For Sarah, the apparent savings from breaking now are erased by that $12,400 penalty, leaving her worse off than simply riding out 2 more years at 2.49%. Unless rates spike far beyond typical forecasts, waiting until renewal is her clear benchmark move. Breaking early is the expensive gamble here. David has hit his renewal date, so no penalty applies at all. This is the free switch window the FCAC notes lenders generally give. His bank has offered a preferred renewal rate of 4.99%, and it looks convenient. But he hasn't checked whether that number is actually competitive. David's 4.99% offer is 0.74 percentage points above the best market rate of 4.25% for an insured 5-year fixed. On his $400,000 balance over 5 years, that gap works out to roughly $1,800 in extra interest. This is an illustrative interest-only approximation. That's thousands of dollars for simply not shopping around. Because David is at renewal, he can switch lenders or negotiate at no penalty cost. That's the whole advantage of the renewal window. A good renewal rate sits within 0.25 percentage points of the best available. His sits 0.74 points off. Checking 3 to 5 lenders here saves him about $1,400 to $800. Priya isn't breaking anything. Her habit is quietly accepting whatever her lender offers at every renewal. She's paying about 0.75 percentage points above best available each time, per consumer advocacy analyses of big bank offers. With 3 more renewals ahead, that small habit compounds. Before I get to Priya's number, the most counterintuitive part of this, it's not the penalty that costs the most. It's the pattern. Over 3 more 5-year terms, 15 years, Priya's 0.75 point premium adds up to roughly $45,000 in extra interest on a stable $400,000 balance, an illustrative figure assuming a steady spread. No single moment feels expensive, which is exactly why it goes unnoticed. This dwarfs Sarah's one-time penalty. If this is useful, subscribe. The next breakdown is already coming. The biggest lifetime loss in these 3 stories isn't a dramatic early break. It's the quiet, repeated acceptance of an above-market renewal. Priya loses around $45,000 without ever feeling a single painful bill. That's why shopping every renewal matters more than any one break decision. Here's the comparison. Sarah, midterm with a low rate, faces a $1,400 penalty and should wait. Breaking now costs more. David at renewal saves about $1,800 just by shopping instead of accepting 4.99%. Priya, the auto-renewer, quietly loses around $45,000 across future renewals. Each figure is illustrative modeling based on the same $400,000 balance. If you're midterm like Sarah, request a written payout quote before doing anything. Over 2 to 3% of your balance usually means waiting wins. If you're at renewal like David or Priya, compare 3 to 5 lenders and negotiate. Anything more than 0.25 points above best available is money left on the table. Next, I'm decoding the mortgage stress test, how OSFI's qualifying rate quietly decides whether you can even switch lenders at renewal, and how to pass it. If you want to catch that one, subscribe so you don't miss it. Run your own payout quote first. It costs nothing and could save you 5 figures.